10-year US Treasury minus 2-year US Treasury curve is tightening. We are close to the zero. It's actually 14 points at the moment, 16 if we look at the markets. Let's directly dive in, look at this. We are in a momentum that we've not seen since a long time. So we're going to look at that later. Let's start with our weekly datas. We can note the volatility on the VIX is higher than 20. That's something usually not the norms, but we're going to deeper. We're going to talk deep through this in another video because I wanted to talk about the 10-year to 2 years difference, the 10-year to 2-year difference. So on the 2-year, you can see we are at 5.08. On the 10-year, we are at 4.92. So about these week datas, I go through it just later, but so you understand, we have a difference between those two Treasury 10-year, between those two bonds, and that's what we'll be looking at this week. On the 6 month, we had an decrease of minus 0.8. On the 1 year, we also had a downtrend of 0.3. On the 2 year, we had a flat week with a 0.04 increase. On the 5 year, sorry, yeah, I said it wrongly before, but on the 5 year, it's 4% increase. On the 10-year, we had 5.7% increase. On the 30-year Treasury bond, we are at 6% increase. So you can see the difference between the 6 months Treasury going down by 0.8 and the 30 years increasing by 6%. So that's what explains the gap like being filled between the 10-year Treasury minus the 2-year Treasury. So before that, let's just make the math together so you understand. This week we had on the 10-year 5.077. On the 2-year we are at 4.918. So you do the 2 years, the 10 years, sorry, minus the 2 year, and you got the 0.16. I might have said the wrong ones, but you got my point. Here we got 0.16 points negative, so close to zero. That's what I said in the introduction. We've seen the dollar going down. I was thinking of a dollar getting stronger because of mainly the situation in the Middle East. Might be the results we had on the retail sales, the numbers, because they were quite high. So we'll go through this when we'll look at this week data. On the S&P, we had a big red candle. As you can see, this week we went down by almost exactly like 2.7%. We've touched this point, so our Elliott pattern is confirmed. We've closed below our previous monthly low, which were at 42.87, 85, sorry. We are now at 42.20 points, 24 to be precise. The support, our support zone is basically our previous gap, our previous imbalance that was during May 2023. This gap, this imbalance have already been filled, we can say, by that on the weekly level. But if you go on the daily level, of course, you will see there are still some gaps here, such as that one here that is quite big. So that is a zone we'll be looking at, basically between the 0.70 and 0.79 of the previous the last uptrend of the three impulses of the Elliott pattern. Basically, if it retraces to this, that would be the let's say the first stop, if we can say. We have the 50% also, but we are very close to it. So that's why we will be looking at next week, because we are on a support, we can say, on the liquidity support, not a retail or something, but that will lead us to those levels. We'll see that on next coming days. About gold, I wanted to have a look also with its you can see here $1997 on the ounce of gold this week, mainly because of events in Middle East. It was priced on gold. We've been through our zone between 0.70 and 0.79 of the previous downtrend. Not exactly the 50% of it, but quite below the 2000 point. Actually, that was a strong point. So that was that's why we stopped here. We created huge imbalance here on the weekly level, and you can see our 79% retracement will lead us to that level, and that will be kind of the same of that 50%. But we already tested it, so we might come back only to the 50% of that last uptrend. So that would lead us to the up of that zone to the 1900 basically. On this week, like I was saying, basically this data, the economic became stronger, defying forecast. They are saying here with an increase 0.7. That's something that was not expected by the market. You can see we were forecasting 0.3 on Tuesday retail sales on the month-to-month, and we had 0.7. So it's actually 130% more than the forecast. And on the core retail sales, we have 300% more than the forecast, 0.6. Yeah, that's very important. Also, we are seeing actual numbers quite higher than the forecast. So it's reflected directly in the dollar price, because this could this is like this shows signals of inflation, so it weakens the dollar, and as the Fed doesn't show signs of hike, they will not be priced of a higher dollar. There will not be prices of a higher dollar in short term and midterm. So about those rates, we have the next FOMC in 10 days. Now it's actually 100% chance that there will be no hike and basically no change for the next FOMC. Now, last week we were at 94%, if you remember. So now, not next week, but the week after, 1st of November, we are quite sure there will be no change. What we all will be looking at will be this peak of Powell. I forgot to mention next week data's quite. Let's look at it in a moment. Yes, we have GDP numbers on Thursday. That will be very interesting. Forecast 4.3, which is something we'll be looking at before, because it could be higher than the expectation. But well, last July, for last quarter, we had 2.4, while the forecast was 1.8. So now the forecast is 4.3. If we have a difference of, let's say, 40% like that, we could expect a 5% to 6% advanced GDP number. We'll be looking at this, and that would be something also the PCE, the personal consumption expenditures, will be looking at this also. It's quite important at that point to have all the datas, and like I mentioned before, like our info MC the week after, but next week we'll talk about that. I'm not going to spend too much time here because we were already on the long video, and I want to talk about the 10-year to 2-year Treasury. So we can see that we are almost back to our 0 points. So we inverted in July 2022. Really, we touched it, let's say, in March 2022, but we inverted really in July 2022, third quarter of 2022. We are now close to the zero at actually here 0.14 points. So that's closer than the 0.16 I've said at the beginning. So that's the title of the video, and we'll be looking at this in the same time with the net percentage of domestic banks tightening standards for commercial and industrial loans. So basically it's the loans given to the market by the banks, and we can see here we are at levels more than 50 where we've never been there except in the 2000 crisis and before the subprime crisis, and that's something we can also see on the net percentage of domestic banks tightening standards for credit card loans. That's basically the same uptrend we are seeing. That's quite shocking. Most of it is not like about most of it, when I'm talking about loans and everything, is about the delinquency rate. And on this chart we cannot see like a huge spike. I've already talked about it. We are at 2.7, 2.8. But if we look at that one, which is the delinquency rates, but without the top 100 banks, and it's RG Financial, which I recommend, Joe Brown, his channel, that mentioned that we are now at all-time highs at 7.5%. And the reason is basically people are like you letting go those cards before the major banks, they want to keep the famous banks like clean their profile clean, let's say. So they let the small credit cards go away. So we can see the delinquency spike right before on those banks before it will impact the others on midterm. So we'll definitely be looking at this. Well, that will be the end for me for this long video. You can see 7.5% delinquency rate on credit cards. That's quite high. So we'll also be looking at this on other videos. I wish you an amazing week. We had this report on Sunday. I was in an important meeting in Marseille last week, in my last week's yesterday, sorry, my last week's in France. I'll be back in Paraguay in three weeks from now. So I wish you an amazing week, guys. Not gonna tell you all my life, but anyway, so you have a new background in 3 weeks. Well, wish you an amazing week, investors and traders, and talk to you soon. Bye bye.